Hey everyone, right now we are going to get into a discussion on what tax saving fixed deposits are. My name is Deepika Jaikishan and I am from My Way Wealth. The objective of today's discussion is to help you understand whether investing in tax saving fixed deposits makes sense or not. Tax saving fixed deposit investment options have been available for several years already. I know of many people already making investments into this every year without really understanding several features of this. A tax saving FD locks in your money for 5 years, which means for 5 years you cannot access that 1.5 lakh rupees that you might have invested under Section 80C into a tax saving FD. Also, this tax saving FD cannot be broken prematurely under any circumstance, and nor can you take a loan against this FD. A tax saving FD can be invested through any private or public sector bank except any cooperative or rural banks. I would here like to compare the ELSS, which is the equity linked savings schemes, versus a tax saving FD. In the case of an equity-linked savings scheme, your money is locked in for a 3-year period, during which you could also choose a dividend payout option, whereas in the case of an FD, you cannot choose for the interest to be paid out year on year. You will, however, have to pay tax every year on the interest accrued. Let's assume you make this tax-saving FD investment when your income is 7 lakhs per year and you fall under the 20% tax bracket. So technically you made that investment of 1 lakh to save 20,000 as an investment. 2 years later, your income becomes 11 lakhs and you are now in the 30% tax bracket. The interest you accrue every year, year on year in that tax saving FD is taxable at 30%. It is important for us to note that this tax incidence just does not fall at the time of maturity, but also during the tenure of the FD. In the case of the ELSS, the taxability falls at the time when you make the investment liquid. While we already understood the taxability on a fixed deposit of 5 years, let's understand the taxability on the equity-linked savings scheme. The ELSS falls into the taxation like any other diversified equity fund, which is 10% above 1 lakh of gains. Suppose you had invested 1 lakh rupees in the tax-saving FD and the value of your money 3 or 3.5 years later comes to about 3.5 lakh rupees, which would mean you made gains of 2.5 lakhs. Over and above 1 lakh, whatever you have earned, in this case 1.5 lakhs, you would pay a flat 10% tax on it. So which option should you go for? If you know that you are willing to park that money for a 5-year period, my strong suggestion, and from all of us at My Way Wealth, would be to make that investment into an equity-linked savings scheme. Since you already know that you're willing to lock in that money for that period of time, leaving it untouched, the possibility of you making double-digit returns or returns which are fairly higher than that on a fixed deposit are high. A fixed deposit would tend to give you, let's say, probably current levels with a revision about 7.25%, where an ELSS, if you go by historically, over a 5-year period tends to give you 14% upwards, which is almost double of the return that you might receive on an FD. So who are tax saving FDs for and who are ELSS investments for? For people who are nearing retirement and are probably say 5 or 7 years away from it and want to secure some amount of their money, it might make sense for you to invest in a tax saving FD. However, if you are young, by young I mean you could be anywhere between the age group of 20 to 40, it would be a good option for you to consider making an investment into an ELSS fund.